All right, so looks like we are here. It's 11:30 a.m. Well, and we're still waiting for her to come back in. So let's give her another minute here. Hopefully, I think she can still log in with yours. I wonder if she can change the name.
Just say my name at the bottom.
Okay. For those who are here, we're just waiting for one of the attendees, and if you could just give us a minute or two. We do apologize for starting a little tad late today. We're going to start, we'll give her a minute. If not, we'll just get started, and she can slip in there when we are talking. So, because we are live right now. So that's we're on YouTube live. So I just want to, we're cognizant of anybody who's there. All right, let's get started, Sean, and I'm sure she'll join us. She's coming in. She will jump in.
I just texted her and said if she couldn't find her own link, just use mine, and there can be two Seans. She can be the much prettier one.
Sure. All right. Welcome, everyone, to the KoreSummit Webinar Series 2021. My name is Oscar Joffrey, and I want to welcome you all to another great discussion that we're going to have today with two great panelists. As always, you know the format. It's fun and play. We're going to have some fun, throw some balls at each other, but no PowerPoint presentations. It's not we're not here to plug in products or sell products, you know, Starbucks coffee, of course, no. It's pure discussion between thought leaders. These are the people doing the work day in and day out. And we're here to talk about in general terms. And then, of course, we're going to give you an opportunity to ask questions for 15 minutes. So the total session is about 1 hour. And obviously, we try to cover as much as we can during that time. But as you know, it can overlap. But don't worry. All the webinars are recorded. They're available on the YouTube channel under Core Connects. As well, you can go to KoreSummit.io and you can see the speakers, their contact details and everything. So it looks like we are all here and we're going to get started. So first of all, before we get going on the topic itself, let's have our panelists introduce themselves but let's start with Sean in red. And that would be
I think you did not say Sean inbred, but Sean in red, which would be Lara.
Please, Lara, take a moment to introduce yourself.
Oh, sorry. Hi, I'm Lara Slakta. I'm the chair of the private funds group at Fisher Broyles. And I also run a broker-dealer called Valuation Securities, which is focused on social impact investing. And I'm having technical issues. So while you continue to facilitate this, I'm gonna see if I can log myself in properly.
Oh, it's okay. We can clearly tell the difference between the two Seans. it's clear, black.
Really? I'm Sean inbred.
Yeah. All right, Sean, you're on.
Hey, thanks, Oscar. Nice to be with you today. I'm Sean Levine. I'm the managing director and head of RegA and CF raises at Entoro Capital. Full service broker dealer, licensed in all 50 states in the district. Firm normally has historically focused on Reg D, but we've made a big push into Reg A in particular over the past few years. And I personally, I'm an attorney, although I'm not practicing in this context. I'm just a banker. I have 4 securities licenses, and I've also had experience in the financial publishing space, which plays into how I'm positioned in the firm's broader distribution and focuses sort of a hybrid bank and BD, but also marketing support firm. You're muted. You're muted.
I kind of figured that after I'm talking, my lips are moving and people are going, oh, that's funny. Yes. So as I was saying, we have a lawyer in the room and we have a broker dealer. So look, I'm going to start off with the great news for RegA. There's been a little buzz going around for the last 45 days. That's kind of put everybody on pins and needles is, are we moving forward or not? And I'm really excited to tell you that on the 29th of January, that has now come to full fruition, we are moving forward with RegA to be increased to 75 million. I know there was a kind of touch and go moment there when people were talking that there may be a freeze on it. That's no longer the case. So everybody can rest. So everybody that's here right now, you can move forward on your raise for 75 million. So that's the good news. Now let's get started in the conversation. As on today's topic is really important, because how do I know if my company can use RegA? And this is an interesting question, because US is one of the largest capital markets, private capital markets in the world. So everybody's going to be looking at this from different perspectives. So we're gonna address it right from the top. Obviously, Laura, I'll go to you. I mean, the part about this regulation is that it's very particular about where the companies can be domiciled and who can actually use it. So love to hear your comments on that.
Yeah, so it's essentially Canada and the US. Is that your question, that where can the companies be domiciled?
Correct. So you're right. So the companies can be domiciled only in the US or in Canada, and obviously we are seeing companies from other regions to utilize this exemption. We obviously the success stories like BrewDog out of the UK. We now have a company out of South Africa. We have a company out of Australia. So the question is, so if only US and Canadian companies can utilize this, what are those particular requirements that would say, yes, I do qualify to use this exemption? Obviously, I need to follow additional legal steps.
Yeah, I mean, presumably you can set up a US subsidiary and do the offering out of a US sub. Is that the structure that you're seeing? Yeah, I think you're muted again.
Yeah, sorry, my apologies. Yeah, so the structure we are seeing is where the company, I mean, the first question the company needs to really ask themselves is, are you really moving into the do you have any business in the United States? I mean, if it's merely accessing capital, it's not going to pass the muster test. But if you truly have a gateway that you are going to eventually enter the United States, it's not just creating a sub, you're creating a company with offices and directors. And obviously the parent company will have an ownership element to it, like BrewDog and many others. And then the capital that you raise stays in the United States. I mean, you can use it to expand and all of that, but it doesn't get pushed back to the parent company. Sean, I mean, yourself, in Toro, we're now starting to see that more and more. We need to have these discussions because, the audience is coming from all over the world, right? So that's really the part of this, asking that question, how do I know? We're not excluding people from other countries. It's just additional steps.
And it, you kind of went through some of the interesting considerations and things that we have a lot of deal flow and we meet folks from all over the place. And that is something that, it looks like it's a simple either or, but it's really not, because it feels like there are probably lots of shades of gray for maybe a historically international company that wants to take advantage of the exemption. Then that's something that I'm in. And again, I'm not an attorney in this context, but it's something that I normally, when I hear that, I start asking some of the questions that you were asking, Oscar, and just how much presence do you really have? Because SEC does look at this. It's not just, where you just go file it and go. And I suspect that it's, to the degree that if you're out of Zimbabwe or something, that, how much scrutiny is that going to get? And I'm interested. My response normally is, if I don't really know, I always say, well, this is a question for your counsel, and you should get this resolved before we go any further, because there needs to be a good view and a good defensible case for why there's a path forward, if you're in that position. So yeah, I'm interested in any sort of bright line tests or gradient, rules of thumb that you might use, Laura, if you were asked that, if you had somebody international, kind of what considerations would you look at?
I mean, for sure, you still have an audit requirement on the tier 2 anyway. So you're gonna have 2 years of operations that have to be audited, bare minimum. So you have to presume that even if you're setting up the sub, that it's operating, that there are resources there that can be allocated towards doing the offering, which is expensive in terms of all of your legal and accounting professionals, as well as marketing folks. So it's not simply drop a sub, run it through the sub. It's really, is it a standalone entity? The subsidiary that you create has to be a standalone business and audited itself and subject to all of the requirements of Reg A, which are relatively onerous. It's not as simple as doing a Reg D offering with no filing requirements. So I think usually the audit threshold is what differentiates between doing a Reg CF versus a Reg A.
Not really. I think if it's just I don't think we can. The audit is purely the reason. There's other reason.
Though.
Yeah, but from a foreign issuer perspective, even if they created a sub, what a lot of people don't realize is that. Give you an example. If you're a company out of Australia and you decided to come in here and do a Reg CF and created a sub, and your intellectual property is still there, and then you want to do a Reg A, you kind of killed your Reg A deal. It's well documented that the structure, if you're going to do a Reg CF before a Reg A, you got to really be careful with that, what the path is to make sure you're fully compliant. But in this case, I think we're seeing a different type of issuer. We're seeing an issuer that's coming in from parts of the world where legitimately they do have business in the United States and they need to set up. Maybe they already started the first step creating a company in Delaware and merely from an operational tax perspective only. And now to really take advantage of the Reg A, yes, to your point, they need to do audited financial statements and all that. In particular for countries outside of the United States and Canada. We're going to touch on the Canadian side here shortly, but in the reason this is now front and center is because to give you an idea of the number of requests coming in today versus a year ago from issuers outside of the United States and Canada is now more than double. So why? Because the success stories to date, when you look at BrewDog, out of the UK, more UK-based companies are coming. So the legal structure has to be created, or people have an understanding how to do it, and how does that tie in with their filing? Otherwise, the whole deal gets unfolded. So, but I appreciate both your comments on it. Obviously, this goes without saying. I want to put it in front and center because
Oscar, can you? Yeah,
yes.
this is really helpful. If you can you give us some examples of the structures that you've seen?
Well, the structures are it's not so much simplicity as it is they need to have a fundamental business operating in the United States. So the mistake a lot of people make is that they go, oh, Oscar, I already created I got a shell company in Delaware. No, it's not just creating a shell company. You need to have a fully operational company. You're going to go through an audit. You need to, whether you got revenues or not is irrelevant, but you need to have people that are going to be here in the United States or in Canada that are going to be operating this business because you're raising money from Americans. You're raising it from 233 million Americans to create jobs and obviously bring them a return on investment. So the model is, when you look at BrewDog Breweries, they created a BrewDog USA, and they've done this in other countries. They brought in a CEO and they brought in a CFO, and they're Americans. They created a business. They have a brewery in Ohio, Columbus, Ohio. Sorry, they even have a hotel. So the capital they're raising is to build out the business in America. It's not to take the money and ship it back to the UK. I think that's what everybody thinks. So you've got to really think about is moving your business into the United States, and you need capital to build out that business unit. And if that's not the structure you have, this regulation may not work for you if you are outside of US and Canada.
What if it's a natural resource play abroad, but the hub, the home office is in US or Canada, as long as a lot of the proceeds of operations are going to be funneling back into the States, then that's fine.
That's okay. Yeah,
I mean, we see that, but I just wanted your thoughts.
Yeah, that exactly, we're seeing that as well. It's a US based company with oil fields outside of Africa, right? Yeah, but it's all coming back to USA, right? Where the other one is, it's the master, the parent company trying to get the funds back out. That it won't work that way. The
Oscar, when you
Canadians.
say it doesn't work, are you saying that when people are filing their 1A, that the SEC is giving them comments on that? And I'm asking, genuinely asking. I've
No,
only done
it's
it for big operating, US companies. So you're enlightening me right now. This is helpful.
Yeah, the RegA, in most cases, they don't even get that far because the lawyers that are doing most of the RegA offerings today really put a stop to it and they go, no, this structure isn't going to work, right? So the structure that is working is where you legitimately, because there was a company, just so you know, it got stopped from India. So here's an example where he created a Delaware corporation. He had a US phone number, but he was in India, right? All the money was being pushed back to India, and the SEC put a stop to it really quickly. So you can masquerade it as much as you like. And I'm certainly not picking up on India here for anybody listening, but it's important to you to understand that by using this regulation, understand the full perspectives of what they intended it for. And that was to create jobs, to build a business in the United States. And it doesn't mean that you can't be from another country. So again, BrewDog. I'll give you another one, Elegance. Elegance had a brewery. And the brewery, all the operations are managed out of the United States, and they're buying breweries all over the world. But the operations, to your point, Sean, it's like an oil and gas. It's coming out of the US. All the offices and directors are in the United States. So but it is imperative for everybody thinking about this before you incorporate, before you start spending any money, speak to a proper legal counsel to get advice on the structure and let them know exactly why you're doing it, because that structure could be, there could be implications about whether you can or cannot use Regulation A going forward. So this is a rule for companies outside of US and Canada. So now let's talk about Canadian companies. So Sean, have you had any experience yet with Canadian companies or?
We've been engaged by, well, there's one off the top of my head that we've currently been engaged, but we'll pre-engaged. It's complicated. But yeah, we're working with advising a Canadian firm right now on the process and planning and strategizing and kind of pre-marketing and things like that. But we don't have any that are actively raising that have been qualified or anything like that. I know, and you and I have had conversations about sort of the nuances of, at least in terms of Canadians being able to participate in these raises and it being adding a lot of nuance there. But I know it's a whole separate animal.
And Laura, what about yourself?
And I have not done one for a Canadian company. So please, Oscar.
Look at this.
Share. I know. I know.
We're interviewing you.
Oh, yeah. Well, I didn't, and it wasn't meant to be that way. So I do apologize. But I thought I'd put that. The reason I put it out there is because we're getting the questions from everybody. And I just wanted you to understand where things were. So listen, anybody from Canada, I don't want to spend a lot of time because we have, I want to get right into the other items, but Canadian companies, same thing. Don't make the mistake of thinking that, oh, you know what, I'm going to just create a subco and go out and do it as a US-based company. It doesn't matter because the rule was for US and based Canadian companies, which means now you'll have the subco you'll have to do in GAAP and you'll have to do financial statements in IFRS. Now you're paying double. So you can stay as a Canadian company, stay in Canada and do the capital raise, file your Form 1A with lawyers like Laura and of course, Sean as your broker dealer. There is one slight difference. A Canadian company, which is incorporated in any of the 13 provinces in Canada, cannot sell securities to Canadians. Okay, cannot. There is no wrapper. People talk about a wrapper. There is no such thing as a wrapper. There is nothing that you can sell to a Canadian that would give them the same rights as you're giving to everybody else in the United States, which is a free trading security, to be able to be transferable or anything that. There's no such exemption in Canada currently exists. So I don't recommend that for anybody using that. It just means it means that it's a fee charged to to the legal community, where you end up paying for an offering memorandum, which you don't need. So it's a little different.
But they can still raise, the Canadian company can still raise in the States. They just can't.
Yes.
They can't raise in their home country under a RegA.
It's rather interesting. Yes, they can raise it in the United States, but here is the part that everybody's going to laugh at. If you're an American company, you can sell to Americans and Canadians. Isn't that interesting? So people go, oh, why don't I just go and incorporate in the US then, so I can do it? You can't. You would have to transfer all the assets of your Canadian entity to the US entity to become a completely US company. You can't be a subco because it will be exposed during your RegA offering. Like I said, why are we covering these? Because these are where we're at now. The dollar amount is bringing out all these different types of companies who are saying, I really like this exemption. And I just did a presentation to Canada's largest broker dealer, and they're going, I get it. All right, so we're not going to be able to sell it to Canadians this time around, but that's fine. I mean, let's just move forward. Did you see what I mean? So people are starting to understand it. It's a barrier, but it's not a major hiccup along the way. So hopefully that was a bit of informative, but I don't want to get stuck on that too much. The legals for me were an important part, but I want to move on to the next part before you guys interview me any further. I feel like I'm on the spot now. You guys really caught me off guard today. Sean, I'll deal with you later, but that's okay. So, all right, let's get started. So I'm going to start with you, Sean, because obviously we are always dealing with the companies head on. And the first question, okay, we dealt with the legals. What else are you asking to know if this regulation is right for my company? I'm a US-based company. What's determining that?
Yeah, and that's kind of where I saw the value. I mean, I'm not the lawyer. I'm not the lawyer in this context here, and I was planning on cheating a little bit on the topic anyway. And just the idea of just because you can do something doesn't mean you should do something, and that's so which companies should be using RegA is more what I would dive into a little bit. And there are a number of considerations that issuers should be thinking about. One is just the time and money involved. Other than full-blown going public, this is out of the exempt from registration types of offerings. RegA is by far the most expensive and time-consuming. You're looking at 150,000 ish, potentially more if you start engaging marketing firms and things on top of it, between legal and the audits and the BD. We're pretty modest piece of that, and then there are a lot of government costs involved, and of course Oscar's got to get a little bit too. So you add all that up, and it's not cheap. And so you need a reasonable capital pool on which to be able to draw to get to the other end of the process. And additionally, it can take, again, conservatively, hopefully everything goes very smoothly, and it's still a 3 or 4 month process. You give yourself about a month to prep and get your financials and have your lawyer draw up the 1A, and then 2 or 3 months worth of review by SEC. Probably give them a month to get back to you, and then 1 or 2 more months of back and forth until they're satisfied. So you need to have a decent capital pool, and you need to have some time. If you need the money desperately, then potentially a Reg CF bridge round or something might be, and it's also cheaper, might be a good answer. Or if you're connected to enough big check writers, then a Reg D can be launched pretty quickly, and you don't need there's no approval, so you just do it, and that's so that's a consideration. Another thing that we see not infrequently is pre-revenue companies are not always going to be the best fit for RegA. particularly because, I mean, again, Reg CF crowdfunding, that's the one that used to be, well, up until for the next month or so, it's still going to be $1 million cap on those raises. It's going to 5, but that's you see a lot more pre-revenue companies in that it's kind of like a junior version of the Reg A, at least in terms of scale and scope of what you can do. You know, Reg A, you're 50 and soon 75 million. So that people expect, investors who play in the Reg CF space are a lot more used to seeing pre-revenue companies. Reg A, you can rationalize it, but it's nice to be a little further along. It certainly makes us more comfortable in getting involved if you've got some sales, you've got a minimum viable product, and you've got some market penetration, and you just want to scale. Some exceptions, you know, maybe look, again, large natural resource projects and pharma, you know, situations where companies may go for years without having any revenues, and everybody understands that, and it's just part of the nature of the beast. That may be okay. It's a little more acceptable there. But if you're a consumer goods product or some a company, and then, you know, you should have some sales. And the problem is, in addition to how it looks and what kind of demand there might be for that in the market that you're targeting, when you're going for an A and if you want to raise 30 or 50 or 75 million, as opposed to 1 or 5 with a CF, you're going to want a much higher valuation, because if you give yourself a $50 million valuation, which might be maybe reasonable for a pre-revenue company if it's really well positioned, like really well, then okay, how much you're gonna sell 30 million, and you're gonna dilute the heck out of yourself. You know, founders don't want to, you know, and this can be an earlier funding round for a lot of these issuers. So you don't want to just dilute yourself really heavily right out of the gate. So the alternative is, let's pump our valuation to the roof so that when we raise our 50 million, we only, you know, dilute ourselves 20% or 10%. And the problem is, it just it doesn't pass our smell test. I mean, it's not something we don't want to get involved with, you know, a $250 million value pre-revenue company. It doesn't feel very good. It doesn't look right. I'm not saying it's not illegal. It's just kind of bad. You know, is that a good investment? You know, we have a responsibility to, when we're pushing stuff out there, to say, you know, this is a reasonable investment for somebody, you know, and then you've got to look and see if it's one for you. It gets hard. And it gets hard to, you know, if anybody who does look at that, it gets hard to get that. And there are distribution channels who care about that we use, that they're not, you know, we don't contract with them, but they're partners that we leverage to get lots and lots of eyeballs on your deal. And even if the end user investor isn't sophisticated enough to understand that maybe they're getting a little bit of a bad deal on the valuation, the distribution partners know about it, and they may take a pass on your deal because of that. Go ahead.
Sorry,
Good.
I'm just gonna. There's a.
Yeah, I don't want to monopolize. Go ahead.
No, it's not that. It just, I wanted to touch one step there. I appreciate the comment, you know, making the fact that the company needs to be, you know, hopefully revenue based, but we also be, you know, I always go back to the very core of the Jobs Act. I really do, because I think with the minute we make it Reg A a commodity, we will make BDs, broker dealers, a commodity, which is what happened, and I disagree with that as well. So the Jobs Act was created for various reasons: democratization of capital, to allow everyday Americans to invest. So that we're giving. Number two, to allow the owners to get their ownership back. And this was so I do agree with you that there are times where we do have these overzealous entrepreneurs, but that's entrepreneurship. They get overzealous on what they're doing, and their valuation and all that. But one thing that I do know that is very clear now, and you know, we've had numerous conversations with the SEC about this, and that is, if the company feels that is what their value is, they're not interfering in it. They're not. This is where they're saying
you're not going to get your raise is not going to be kicked out because of that. And I'm not saying it is objectively wrong or immoral or something. That I'm just saying market palatability and market fit. You know, you can set your terms at whatever you want within, you know, some degree of reason, but you know, you can shoot for the moon, but you don't want to make it so hard for yourself to succeed that, you know, if you wanted 30, but maybe you can only get 3 because of something you did, it can be harder. The more you do that kind of thing, the harder you make it for yourself. It doesn't mean it can't work. It absolutely can. And I've seen, to your point, seen plenty of pre-revenue companies and even some in consumer products that have succeeded with the right partners and the right promotion. But
Sean, do you have some like rule of thumb, like how do you guide people to figure out what their valuation should be?
I mean, valuations, you know, our managing partners, Jim, you know, more of an art than science. But there are like, look, I've done due diligence support for some CF issuers in the past as a consultant, and you know, you look at, honestly, you know, pre-revenue companies could be in the single-digit millions. I mean, just looking at traditional capital channels and angel and venture capital and things like that, and you know, that's a benchmark. You know, we realize going to the crowd, look, the crowd does not normally have access to some of these deals. So oftentimes you will get a bit of a premium because and that's the trade-off. You know, for them to be able to get into this, sometimes they're paying a little more than a venture capital firm would pay. But for you, under the VC model and angels and everything, you know, pre-revenue, if somebody's not really well positioned, like if they're in the Valley or they're in New York where there's a huge capital pool nearby or expertise nearby, you know, 5 to 10 million is not crazy. And you don't really see that for Reg A's, again, because you're generally raising so much money that, you know, I mean, we have some clients with like a 40 million pre-revenue, and we didn't even love that, but you know, it's reasonable. It's not crazy. I get it. And so we worked with them. We figured out a way to work with them. But so that's what, you know, kind of thing we're seeing is more in the 30 to 50 million for pre-revenue. But you also see that for companies that have revenue that are doing Reg A. So as an investor, you know, you can kind of shop around a little bit and you might find a company that's going faster, but there's still, if you really like the story and what a company's trying to do, seeing something in the, you know, 30 to 50 million pre-revenue in Reg A, you're going to see it. That's kind of, that's, Oscar, is that kind of what you would normally see somewhere in that, with a few exceptions? Sometimes you see people, and it's natural resource folks in pharma who shoot the moon, but they may be deep in federal, in FDA testing, or they may have, you know, done a lot to move toward getting to cash flow, and it might justify it better.
Yeah, the one comment I'll say about the whole element of pre-money valuation is that if you look at all the live offerings today, there's no way for any investor to know what the pre-money valuation is. So I think we need to put that in. It's not a significant figure. I think those participants that work more in the Reg D world, like when you do a term sheet, it's right there. There is no term sheet here. If you go to any live offering right now, I constantly go out, and in fact, we even have people calling to the company, "What's your pre-money valuation?" What is that? They don't even know. Their lawyers didn't even do it. Their broker-dealer didn't do it. So I think that maturity is coming. I know, but it's nowhere on the site, and they're not gonna. Their marketing person is never gonna allow it. I already know that. No marketing person is gonna allow that information to be available. It's in the offering document, which is there. That's,
I mean, you very easily can calculate what the valuation is based on what they're selling the shares for and how much equity they're getting. So I mean, it's.
I don't think they ever say what percentage of the company they're selling, though. I think that's the other.
There's the other part, right? So I think I'm not disagreeing with you. I just need for us to understand that the industry is going, the whole sector is going through a momentum of change. And what was then, you know, and there were deals with no revenues, raising significant amount of capital. There were companies where it was just an idea and they did it. To date, as of now, of the deals that we see live right now, not a single one has the following. You do not know what the valuation of the company is. You do not know how many shares are fully outstanding, to do the math, to your point, because that's what you need. You need to know how many shares are outstanding times the share price today. And it's not about what you're issuing, because that's just telling you what you're issuing.
Yeah,
So
the shares are, yes, this is the cap table information's in the circular. The information's there. And if they give a range, if they don't know how many shares they're going to sell, they give a range. Well, you can benchmark it. You can say, all right, well, if you sell this much,
agree.
this is what it is. And if you sell this much, so you at least say this is where you're bracketed, and you split the
100%.
difference, and you can come up with these numbers. It's not.
I agree. So let me put it in another perspective. All of that is in the Form 1. So maybe the question you haven't asked me: how many people click on the Form 1? Okay. See, there's a difference between, like, I can go to a website right now and you'll see the offering, all the details, the offering, and the offering is a link. Nowhere on the website, to black and white, are they talking about valuation or anything like that? So
sure.
What is it's
the
not
retail investor doesn't necessarily. The problem is when you start to look. Something we talk about is how everything's kind of converging slowly.
Yes.
And by which everything, meaning, capital channels and traditional means of raising capital combined with retail and hybridization of these concepts. I mean, we have multiple deals right now that are wanting to do Reg D and Reg A at the same time. If you're going to set those terms, I mean, and you can structure you can do 2 rounds and structure them differently. But to the degree that you want to be, and again, more and more, this is going to become an option to the degree you want to hybridize and try and reach, or you can just do a Reg A. There's nothing stopping institutions and high net worth folks and accredited investors from participating in Reg A.
No, agreed. But do you think
people care?
But do you think, so to your comment, do you think that we're now moving into the part where the people go to the website? So let's just, because I even go to the platforms, WeFunder and all that, they don't even show it there. But on the company's website, do you foresee now that broker dealers like yourselves will be saying, you know what, we need you to also indicate what your pre-money valuation is? And because I know it's on the circular. I'm not talking about what's in the circular.
When you say indicate it, you mean we steer them to put it on their easily accessible retail facing? Not necessarily, because again, if we work with the issuers in the retail channel, and again, we're hybrid marketing-esque in our activity, and some of the all that may do is if it's excessive, it may keep you from tapping into some of those distribution channels, which is something to consider. But you can just run a digital campaign and do your thing. You may not get 50 or 75, but you can raise money that way, and it's fine. I'm just saying that it's a consideration for us, because we know we want the potential to reach out to accredited, institutional, and work that into the raise. And additionally, as everything coalesces and comes together, the deal quality that we look at lots of deals. You look at lots of deals. But for us, because we're regulated and because there's some sort of expectation that the quality of deals is important, that we're shopping around, and you guys aren't held to that state. It's okay. We kind of are, and so if we're deciding who we're going to work with, sometimes that is a factor. And we've had a conversation recently this morning about somebody where the valuation was a problem, and it kept us from getting involved. Because we've got companies that have reasonable valuations that do have sales. And we're okay with working with pre-revenue companies, but if I'm looking at a company that's got 2 or 3 million in sales and doubling their sales rate every year, and I've got a pre-revenue company and they've got the same valuation, I'm going to lean hard into the company that has sales. I've only got so much bandwidth. So that's where it's a factor, because it could, if you don't value yourself appropriately, it could gatekeep you out. And look, every broker dealer is not going to be the same, and some of them don't care. And I know ones that don't care. But you might limit, but they don't necessarily have access to the distribution we have access to either. So yeah.
And Sean, I think it's important that you're acting as a gatekeeper, right? Like the broker dealer really should be acting as a gatekeeper. And I'm sure that there are situations in which people put offerings up directly without using a broker dealer. And then I guess my question is how often, right, exactly. And then the question is like, how often do they change their valuation, lowering it because it wasn't successful? And I guess that's a question for Oscar. Have you seen anything? I feel like now I'm moderating. Have you seen anybody drop their valuation because it just wasn't, they weren't selling?
No, no, we haven't. And I think part of I love 2021, we already saw for the very first time an institutional investor come in. There was Gage just raised $50 million with another broker dealer, and it was at the full retail value. That it wasn't discounted right with everyone else. Um, I'm I'm an entrepreneur, right? So when I drank the Kool-Aid on Jobs Act, I drank it all the way, meaning I'm all in. I believe in the following things. I believe companies need to work with a broker dealer. That is not an option for us because there are 7 or 8 states that you need one anyway. So that's one. Number two, the reason I'm using Regulation A is because I'm on the driver's seat. Not like I want to be in the driver's seat. I want to hear them out, but the professionals are wrong. Andrew Korn says it best. Before you would go to 3, 4 investors to tell you what your value is. Now you can go to 10,000 of your customers and they can tell you what the value is. I'll take this 10,000 any day. And I think, look, I'm not disagreeing with you. It's just that we need to be balanced, I believe, because the Jobs Act was to open it up. If it's just always, everybody wants the cream of the crop. But I will tell you that the cream is very different than anything we've ever seen before.
Define cream. And
yeah, exactly.
And the quality of a product and how much it is resonating with the retail investment base, retail investment community, and the story behind a company and their mission. Those are, in this context, and especially when you're targeting retail, they're outright more important than the valuation.
They are, and I think I'm not disagreeing with anything you're saying. I want to balance it for those,
because I'm not disagreeing with you either. It's right.
Yeah, every broker dealer we're all here to work. We want a healthy ecosystem. We want good companies, and what's a good company? You're a good company. That's it. And here's the reason why. Because right now, the only exposure we have as an industry, everyone in general, we have an exposure to less than 2% of all the privately held companies in the United States or in the world. And they all happen to be venture backed. So that's our benchmark. And we go, well, look at the valuation of a VC company. It goes from 30 million to 150 million. And people keep thumbing in, thumbing down. Well, the only difference is we don't see the money moving back and forth between them. In Reg A, it's fully transparent. It allows us to be able to cash out previous investors, fully transparent to everybody else. So we could do a better job in transparency. That I agree with. That I was kind of leading you into that. I think we should have, I don't think it's a bad thing telling somebody how many shares you got outstanding. You were doing it before anyway in a Reg D offering. Every time you did a term sheet, whether you could just get off the go-go, you still needed a term sheet. The investor needed to know how many shares you're going to issue, at what price, what's the pre-money valuation, how many shares are outstanding. I think that's pretty, but it wasn't made like he had to search it in 300 pages. It was right there. So I don't think that's a bad idea, Sean. I like that. I like the fact that as well, when an investor comes to a website, the broker dealer's name should be there. I think the auditor's name should be there. The lawyer's name should be there. Why? Because Laura said it, we're there to protect the investor. It's not just the broker dealer that needs to be the gatekeeper. Everyone does. So, but I don't want to get off topic. I think we did a little bit, but welcome to the KoreSummit. Yes.
Yeah, let me just jump in really quickly. I worry that to the extent that you take the approach that every company is the right company, that you're going to end up with a lot of either fraud or just inappropriate investment decisions by retail investors that are driven by whatever's the latest, coolest thing, right? Without any thought to the financial returns or any potential financial returns. And so long as people are okay with basically handing their money over, it's fine. But they have to understand that that's what it is. And it really worries me when we start talking about giving a whole bunch of investment opportunities to people who don't have the financial background to understand it and will most likely lose all their money. And I think that's why there has always been this focus on protecting retail investors. So I guess I'm saying I don't want to let the open the gates completely, because it's just going to shut them just as quickly when something fraudulent happens. It's like with the ICO craze, right?
In the long game,
but wait a
that's
minute,
the way to go. It's a factor for the regulatory regime and that we're going to be under is going to look more closely. I mean, maybe not extremely closely, but more closely than previous. And to Laura's point, you know, you don't want to have a couple of really bad deals just blow everything up.
Mm-hmm.
But I just want to caution everybody that it's not going to be fraud. I'm just telling you. I will tell you where the error will occur.
We're going to catch that. People will catch that. It's
fraud.
Due diligence
Fraud
will catch that.
SEC is there for that. That's what the SEC is there for.
Yeah,
the lawyers there for that. I mean, the best lawyers in the game: Sarah Hanks, Louis Vellacqua, Marty Tate, and Laura, your firm. They do 98% of all the Reg A deals. They know what stinks, what doesn't right away. We're going to catch it, but the SEC is going to catch it as well. If there's any bad actors, that deal's going to sink. But even so, where has been the problem? The problem have been not because the company committed a fraud, is because the parties that were involved in the offering, people missed a step. So I'll give you an example of some of the missteps that people think it's fraud. So when you collect the money before you do KYC, so the money's all needed to be refunded. So people think that's a fraud. It wasn't. It was a compliance issue that the broker dealer involved in the offering and the issuer were not on the same page. One thought that did, and it wasn't. And it's still continuing to this day. That is not fraud. That is just a compliance requirement, and the SEC steps in, money back. That's number one. Number two, the next big blow up won't be the issuer. It'll be the broker dealer. It will be the broker dealer that goes to next.
You're really making me want to hammer on this.
I know.
On this due diligence and our gatekeeper function.
And the third one is the lawyer. So we already have. There's already in a couple of cases already where lawyers have committed outrageous work that has caused massive, issues with clients, and so it's there, and they're not.
Tell us more. Tell us more.
Yeah. Well,
I can tell you more, but I won't.
It's the issue is that if you do not get the right lawyer in your team, and you skip steps and you miss things, I'll give you an example. Issuing warrants under Reg A. My God, get legal advice before you do it. You have no idea the issue you're dealing with. It's not just like when you do a Reg D and you issue warrants. Not at all. It's like two separate offerings happening simultaneously, and the way they need to be registered and signed, and a whole bunch of other things that people overlook. That's one. Perks, disclosing perks, no discounts, no 2-for-1s. So all these little things. Everybody is, or online, advertising on television. So everybody is, I don't think that they're going to be blow-ups, but they're not going to be fraudulent blow-ups. They're going to be compliance blow-ups that's going to teach us, okay, we need to be more black on this issue than we were before. So the industry, as in general, is already doing that. The industry has already started a best practices. Our ecosystem of 190 or so partners in doing Reg A's, some of them already started a working paper and best practices from compliance, broker dealer, investor acquisition, and legal. Why? Because we see this. And ultimately it's to protect the investor. But we do have one assurance, regardless of what we're all doing, the investor being fraudulent, being sold a fraudulent product by when there's a broker dealer involved and all that is so, the odds are there. If there's an offering being sold without a broker dealer, without an escrow provider, without any of the regulated, yes, Sean, Lara, I'm with you 100% on that. So how do we protect the industry? Coming up with these practices by ensuring that when a company goes to the SeanLevine.com website, raising 75 million. Sean indicates that his broker dealer is in Toro, and he indicates Alara is his broker dealer, and he indicates that he's using the CoreConnect all-in-one, and he indicates that he's got so many shares outstanding, and that is how we, so people then have a comparable, wait a minute, that Reg A had all that. How come this one doesn't have it? See, right now they have no way of comparing it. That's why fraud can occur from those non-regulated entities. Hopefully I
So
give you
when I see fraud, it's usually, it doesn't necessarily have to do with the company itself. It'll be something like they had an unregistered broker dealer selling for them, and somehow that gets picked up, and then it's low hanging fruit for the SEC to get involved, right? And then they start looking more and more into it. So whenever you see like, you know, an enforcement action related to unregistered broker dealers, it's typically because there's something else going on there. Otherwise, it would never be on their radar. And I think that one of the things I'm concerned about is that you're going to have, you know, one or two easy things for regulators to pick on, and then it's going to open up, you know, we're going to start looking at the entire industry. And this is also where the best practices, I think, is going to be really, really key. That's fantastic that you guys are doing that. Let me ask you this though, like from your perspective, you are the kind of common thread in all of this. So can you put something up on the platform that forces people into that transparency?
Oh,
Because
it
you
does.
see it all, right? Like you see it
Yes.
all.
We see the front line and we see the back line. So we have our standards, our Core Connects, right when we started. We will not take on a client. They cannot use our technology or any of our services unless there's a registered FINRA broker dealer. That's number one. Number two, unless there is a US registered lawyer that's recognized in Reg A and we can see their filings, because we know the other fallout. Number three, that there's no conflict of interest between the auditor and the broker dealer, because the broker dealer and the lawyer. Because we had a client, if you can believe it, two clients. What are the odds that the broker dealer, there was a conflict of interest with the auditor? I mean, so the SEC is looking at all these things. So, but I'm moving it to the next direction. I believe that companies now need to step it up, to your point, Laura, to then be able to go. I've only seen one company do it, and that was Sagoon. I got to give this company a lot of credit. When I went to Sagoon, he had an invest page. He had lawyer, CrowdCheck. He had, escrow, Prime Trust. He had every provider listed one by one. He had number of shares outstanding. So he was the only company I've ever seen. He only had one negative, and now he's fixing it. He didn't have a broker dealer, but nobody told him, right? And so now that's all changing. We're all understanding we need to move it forward. So, for companies coming in, listening, you're wondering, how did this conversation get here? Because this is an important part, actually. Are you ready for this? You can see amongst us, lawyers and broker dealers. So we are looking for the best of companies. And it doesn't mean that whether you're a startup, you're not, or anything. It's just, we need you to come prepared. You need to budgetally be prepared. You need to be mentally prepared. And more importantly, you need to understand everybody is trying to protect everyone. This is not where you're coming in all by yourself. I call it a team sport. Sean and I working on deals together. You know the meetings, Sean. There's 20 people in a room, right? Easily.
Yep.
And that's just before going live. And so when you're going live, that room is just getting bigger and bigger. And to Laura's point, nobody wants to blow up, but it's going to happen. Now we can do all the right things to prevent it, to make sure the quality companies, we're not going to use that word, not quality, making sure that your company met all the prerequisites. There you go, of that particular party you're working with.
And by the way, we are, just to clarify and backpedal a little, we're happy to talk to pre-revenue companies, and we're not going to crush you. We just like to hear something reasonable, but we do work with plenty of pre-revenue companies. You have a good story and something that makes sense. You don't have to just make some sense. Have a really interesting idea that the public is going to want. Then
Agreed.
We're happy to work with you.
Yeah, you bet. So we could keep going. The audience, I forgot to tell you, there's a little button there called raise hand. If you want to ask questions, this is the time to do it. Obviously, we're having a conversation ourselves here. We got carried away, but it's still to the subject matter, which is, how do I know if my company can use Reg A? And all these things are a consideration. Jurisdiction, the size, the stage? Am I mentally ready? Do I have a team? We do have clients that are one man, I shouldn't have said that, but one person show, meaning that they're doing everything. It's hard. We've also have companies that have 15 or 20 people. Whew, that's a tough one too. Because they're, and now you and we have another client, Sean, that is kind of in between. They got about 5 people. I think that's a sweet spot. They can balance all the things they need to do, because one of the things you need to go through, we always simplify saying, hey, filing your Form 1A is easy. Well, we're going to have a webinar about due diligence. And it's really about due diligence on yourself. Do you have all the information they need in these 57 pages? And people go, what are you talking about? Yep, that's what the lawyer needs in order to file your Reg A. And so that's the other part in preparing budget, jurisdiction, stage you're in your capital raise. And know this, if you're in the United States, you have Reg CF, you can raise up to 5 million, and Sean can talk to you about them, so can your lawyer. So you have different choices. Obviously, for the rest of us, the only choice we do have is Reg A to look at and consider as a capital means for our companies. So, so Laura, I mean, you've been the moderator. So obviously, your experience with Reg A's have been to what extent that you've dealt with so far?
So U.S. social impact, including nonprofits. So it's really, my focus has always been on social impact companies. Not always, but that's really my sweet spot. We did one that was a nonprofit debt issuance, which resulted in us having to, set up the broker dealer in 50 states, as well as deal with charitable rules, which was interesting. Wow. But we partnered with a Canadian broker dealer on that, so the Canadian piece of it was covered by a separate broker dealer for that offering. So that's a
great segment, social impact. I mean, we've got 2 clients right now in social impact, and it is different. There's a different type of broker dealer. There's a different way they want to operate, and they're able to grab a community very quickly at times, because there is a following specifically. Like, I have one that's involved in trees, and I have another one right now that's involved in, I believe it's, clean air technology in buildings, right? And it's all part of the social impact element. So that's that's your specialty within the Reg A, because there is additional disclosure requirement. The interesting twist you brought in there, not for profit. That is the first time I've heard of that. So
it's debt though, right? Because you can't have equity in a nonprofit.
You can have equity. And one of the things about Reg A, it's either debt or equity. Straight vanilla. Gotta love that, right? Debt or equity makes it through and through. All right. Sean, did you want to add any additional comments? Hold on, I got my baseball bat ready for you.
To your last point, I mean, we don't really have time to get into it now, but it might be worth, there are a lot of issuers out there wanting to do tokenized assets and things like that. And any kind of parting shots on the complexity or nuances about digitization, tokenization in the Reg A context would be handy.
Yeah, that's a great suggestion. Thank you. It hasn't come up as much, but we're now able to talk about it because we can finally say to people end to end, and end to end meaning from the investment to the point where they can now trade their Reg A securities on a registered ATS secondary market, and they can trade as low as $100. That and again, the only way that's possible is digital securities. It's more of a back end issue, but I think it's warranted. I'm going to make a note of that, Sean, to include that as a conversation piece. So far, you and Jim keep coming up with titles during these meetings. Like Jim's suggestion was to come up with structures. This is new, what Laura brought in. I want to include you on that one, Laura, because that I have to admit, it just dawned on me that you're right. I mean, people keep thinking that not-for-profits can't raise money. They can't raise equity, but nothing stops them from raising debt. in the market, and
And
not for
I will
profit.
say this, I feel better about using Reg A for debt, especially for nonprofit. I feel like that's one of the safest areas for investors because you absolutely know what you're getting. You're
Yes.
going to get a fixed interest rate. You know that it's redeemable, and it's far more straightforward and I think friendly for retail.
Well, and if I understand it correctly, for a not-for-profit, not only do you get a debt holder, but you get a member for your organization. So it's a
Yep.
two-win, and then more importantly,
And they
you can
can
go back.
Yeah, they can decide whether or not they want to donate the proceeds and take the tax
Yes.
deduction. Yeah.
So that's a very look at, see, I learned something new today. That is so cool. Oh, you and I are gonna have
You got me on the wrong panel. Yeah.
that's Sean's fault. I told him to start reading the fine print, but he didn't read the fine. But you know what? This is no. I mean, look, isn't it great to have a conversation that we keep thinking that the only types of companies is for startups or well-to-do, but here we're talking about not-for-profits. How many there are in the United States? 200,000 plus not-for-profits constantly raising capital that are needed to help others, and of course providing a return. But as you said, they would have donated it anyway. Now they can do both. They can earn it and then get a tax receipt. Wow. I think that is a discussion that I never even thought having. Sean, imagine selling not-for-profit.
Oh no, I love it. We've got ties in the impact space. We have a lot of pro athlete and former pro athlete folks who are very kind of ESG focused, impact focused, and work with it. So yeah, Laura, we should talk. If you guys do another one, we might be able to help find some money. But
yes,
it's a good space. It's a very good space. I love the idea of doing this, and also crowdfunding is maybe a younger demographic that we can target, and certainly over time as millennials become a bigger and bigger factor in the investment community and take over everything, they're a lot more socially conscious, and they're looking for those kind of opportunities. So I think it's great.
Perfect. Well, Laura, it was a pleasure meeting you. We're gonna have another conversation. Sean, fun as always. Let's get the gloves out. I'd like to do a webinar with you and Jim just to see how much choking you.
I don't think that would be fit for public consumption, but
consumption. It would be good anyway. I want to thank everybody coming out this morning. Thank you so much for listening to us this 1 hour. I know there weren't many questions. This has been recorded this afternoon at 3:30 this afternoon. The big topic: can research help your Reg A or Reg CF offering? So you're going to be hearing from some of the other speakers in this area. So thank you again, Laura, Sean. I look forward to speaking to you both.